Hey traders, Jason here from Leavitt Brothers. The market is turning up. Last week I did a video titled Hourly Charts Turning Up. You can go onto YouTube, you can do a search for it and check it out, where I argued the indexes were building bases, and we're very likely to break out of those bases. And given how the charts were acting around the key moving averages on the hourly charts, things were starting to improve. A 3-week base was very likely to resolve up, and a lot of charts, a lot of individual charts were also improving too. So in this video, I'm going to continue the discussion that the market is improving, and while I'm not going to go out on a limb and predict the market's going to rally to new highs here, I am very encouraged by what I see. So let's flip through some charts here. All right, so up top here we have the NYSE advanced decline line. Down below is the NASDAQ advanced decline line. As you can see, both have been in consolidation modes. If I put a little box around each one, you can see they've been mostly in consolidation mode for a few months, actually this entire year. But just recently we have the NYSE AD line just moved to a new all-time high. The NASDAQ is lagging a little bit, but is still in pretty good shape. Twice it has bounced off of its 200 moving average. So things are moving up. I mean, if indeed the market was weak, I don't think the advanced decline line would be making an all-time high. All right, so whoops, skip the chart. So okay, so here's the SP500 up top versus the 10-day moving average of the advanced decline line below. For those of you who are familiar with my work, you know that I argue that when the market is healthy, the advanced decline line maintains itself above zero, and when it makes dips below zero, that's kind of a warning. So if I were to kind of look at a section here, during this time the market was trending up. During this time the market was trending up. Okay, obviously we've gone through a period here. We've had a big dip in February, another big dip in March. So going forward, if the market, which is now, the S&P is 150 points off its low, if it's going to continue trending up, if it's going to stay healthy, if it's going to hold its gains and not retrace all the way back to the lows, I'm going to want to see this advanced decline line basically stay above zero. It can oscillate up and down. I don't care if it goes to a new high. It'll form a divergence eventually, which will lead to a little bit of a pullback. But as long as it can maintain itself above zero, the uptrend will be supported. All right, here is, I already showed you the daily version of the AD line in the very first chart, where I said it was going up where it was at a new high. Here's the weekly version with a 30-week moving average. It has all along maintained itself up above the moving average, and right now it too is at a new all-time high. So the longer term charts, I've always argued, have remained in very good shape, and this chart continues to argue that point. So overall, things look good. Here is, now if we break it down, here's the advanced decline line at the SP 500, which is, SP 500 is mostly big cap stocks. You can see that it just recently moved to a new high. Okay, we got higher high, higher low, new high right now. Here's the advanced decline line of the mid caps. Again, higher high, higher low, and now we got a new all-time high. Moving on, here's the advanced decline line of the small caps. Again, higher high, higher low, and now another all-time high. So sometimes if you look at the broad market, you don't get a really good picture, because sometimes there could be such good strength in one area that it covers up weakness elsewhere. Here I'm breaking the advanced decline lines between big caps, mid caps, small caps, and they're all at all-time highs. So that really tells you that the strength that we're seeing, or at least that we've been seeing the last couple weeks, is pretty broad-based. Okay, here's SP 500 up above, new highs down below. Okay, new highs moved up in March, came back down, now they're moving up again. This is a lagging indicator. Okay, when the market trades, as you can see, like with the market trading down here, the initial move off the low, you would not expect there to be very many new highs hit. But as this move continues, as it matures, you do expect new highs to start registering. So this is a lagging indicator. First the market moves up, and then a week or two later new highs start to tick up. That's what I'm going to be looking for. Okay, we're now 150 points off the low. The market has been moving up for a couple weeks. New highs are moving up, which is good. We need to see a continuation of this in order to confirm the market's near-term strength. Okay, here is the weekly version of the new highs. If you look closely, and you might have to pause the video to see this, whenever this is the 10-week moving average on the bottom, the 10-week moving average of new highs. Each time we hit a low point and curled up, the market either bottomed and rallied, or it hit an inflection point and moved up. So for example, right here, let me see if I could, so like in this area right here, we got a bottom and moved up, and then you can see looking up right here, we got a bottom from the market. Okay, and this continues on over here. We got a pullback and a bottom there, and here we hit like a little inflection point where the market jumped about 150 points. Okay, again, you can pause the video and look at it closely. Whenever the 10-day curls up, we get a bottom or an inflection point, and the market does very well afterwards. Right now, we're starting to get a little bit of a curl up. Okay, so that would be good news, and it's just got to continue. Okay, it's a good first step. It tells you that even though the market's up a couple weeks in a row and 150 points, this might just be the beginning. We might actually go another 100 points before we run into some problems. Okay, so this chart tells us, hey, so far so good. All right, here's new lows, which are among their lowest prints of the last 52 weeks, which is a good sign. If there was some trouble beneath the surface, sometimes the market would move up or sideways, and below the surface you'd see like one by one more and more stocks are hitting new lows. It's not the case. New lows are at their one of their lowest levels of the year, so that's good. No weakness brewing beneath the strength per this indicator. All right, so here's the high-low differential. Again, for those of you who know my work, when the market trends up, you know that I want the high-low differential to be above zero. Okay, it can oscillate, it can roll up and down, fluctuate, do whatever it wants. As long as it maintains itself for the most part above zero, the market strength is supported. Obviously, we've had a lot of prints here above and below zero, no sustained prints. So from here going forward, for me to believe that the strength that the market is currently exhibiting is going to last, I'm going to want to see prints right here. Okay. Going forward, I want to see high-low prints oscillating above zero. Okay, as long as that happens, the market strength will be supported. If it goes below zero, all bets are off. Okay, here's probably the biggest warning I have. Here's the cumulative high-low differential. You can see where it rolled over last month, and it's still below its 50-day moving average. Okay, it's curling up. So if the current strength that the market has continues, it's probably going to recross up, but we want that to happen because you can see what happened if we go back to 2015 where this indicator curled down. The market over here in the bottom continued to trade sideways, and then because this indicator continued to deteriorate, the market eventually fell hard. Okay, so we're going to want this to cross back up and not continue down. A couple more charts here. Okay, here's the SP500 down below. Up above is the percentage of S&P 500 stocks above their 20-day moving average. When the market trends up, when it does well, this indicator just kind of rolls up and down above 50%. Okay, simple as that. Okay, you want at least half the stocks in the S&P to be above this key moving average. Okay, you can match up these periods, going back as long as you want, and it pretty much is always the case. Obviously, for the last 2+ months, we've had these big swings up and down. Nothing has been able to sustain itself above the 50% level. That's what we're going to be looking for right now. Okay, so if the market's strength, which has developed over the last couple of weeks, is going to remain in place, we're going to want to see this indicator do this. We want it to stay above 50%. To tell us that the market is healthy and more than half the stocks are above this key moving average, and that strength is somewhat broad-based. It doesn't have to be extremely broad-based, but it has to be broad-based enough. We need some participation. We need pretty decent. We don't need great participation. We need pretty good participation. So this is what I'm going to be looking for. Okay, if this goes below 50% and hangs out down here, I don't think the rally's going to have legs. But as long as this can maintain itself above 50%, the market should be in good shape. Okay, same idea here, but instead of using the 20 EMA, we're using the 50-day moving average. Okay, the concept is the same. We want prints, in this case, we want prints above 55%. You go back in time, the market does well when the percentage of S&P stocks above their 50-day MAs can maintain themselves above the ski moving average. When that value is above 55%, the market tends to do really well. When it drops below 55%, the market doesn't necessarily do poorly, but it tells you that support is not broad-based enough to support a rally, and the market tends to flatten out or pull back. So this is what I'm going to be looking for going forward. I want this thing to print above 55% here. A couple more charts. Here's a chart I've posted a couple times the last couple weeks. Tops, the bottom here is the 10-day of the put call ratio. Tops in this indicator tend to be closely correlated with either bottoms in the market or inflection points in the market. Okay, so I posted this for our subscribers a couple weeks ago, where the 10-day rolled over, topped and rolled over, and you can see these two arrows here showing that. And of course, the market has done really well since then. It's up 150 points. So we're going to want to see a continuation of that. Okay, when this indicator drops to a low level and starts to curl up, that's probably going to be a time for the market's probably going to at least pause. Okay, so this indicator served us well this month. Last chart. Okay, I want to maintain a level head here. I don't want to get too excited about a rally or the strength continuing. I want to keep us well grounded. So I post this chart as a reminder. The market tends to move up on low or declining volatility, and it moves down on high or increasing volatility. Okay, my measure of volatility, or one of them that I use, is the average true range. Okay, I use both a daily and a weekly version. In this case, here's the weekly. When the average true range, again, if you focus, say, on these two, on this area right here, let me highlight it. If you focus like right here, okay, when the average true range is declining, the market does very, very well. Okay, and you can go back and again, you can pause the video and look at this. When the ATR is declining or at a low level, the market does well. When the ATR is moving up, the market flattens out or pulls back. So obviously, it's been moving up, with force the last, this year, and the market has paused. Okay, so for any rally to sustain itself, we're going to want to see this thing roll over and move down. Okay, we're going to want to see this come on down. It doesn't have to get to a low level immediately, but it has to trend down to show us that volatility is declining, and that will help support the rally. Okay, hope you got something out of this. The market is improving. Okay, it's not out of the it's not out of the woodworks yet. It could still head down. There are no guarantees, but I'm at least encouraged by what I see. I've laid out here what I'll be looking for going forward, what I'm looking for in order for the rally to be confirmed. And so far so good. I'm long. I plan on staying long for now. Stops in place. Doing pretty well. All right, so come check us out at Leavitt Brothers, leavittbrothers.com, leavittbrothers.net. We've helped thousands of people over the years navigate the market and help and make money. We can do the same for you. So come check us out.